Good morning and welcome to this Wednesday, August 31st, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, currently, we're in a downtrend, obviously, but we do have futures that have been pointing higher most of the morning. Trying to get an update here for you on the diamonds right now. Diamonds, the DIA, which tracks the Dow Jones Industrial Average, currently up about 0.3%. We've got the spiders, which have actually turned down slightly. Let's see. Yeah, actually, NASDAQ back down to flat. So I hadn't looked in the last 20, 30 minutes, but it looks like we have reversed off of some earlier gains that we were showing this morning. I think one of the Fed presidents, I think it was the Cleveland president, Mester, that reported this morning saying that the Fed was looking at raising rates above 4% and that she was not expecting any rate cuts through 2023. So that at first spooked the market. Then we saw, excuse me, then we saw the market rebound in futures this morning. And now as I'm looking, it looks like we're moving back toward the flat line. Technically, in the short term, we're definitely challenged. That breakdown last Friday after the Jackson Hole speech by Fed Chief Jerome Powell, we saw a lot of selling, went through some key moving averages. Well, the key one was the 20-day moving average, and we have yet to be able to get back up and regain that. So in the short term, that's going to be one of the keys that we're going to be looking at to try to get back through that level. Let's see, why don't we go ahead first before we really get things going here. For any of you that are new to Earnings Beats, I just want to make sure you know, if you go over to earningsbeats.com, a couple things. Number one, we always have a free sign up for our Earnings Beats Digest newsletter. That is published 3 times a week, Mondays, Wednesdays, and Fridays. Simply requires a name and an email address, no credit card required. You can unsubscribe at any time. Normally I'm focusing on things related to earnings, gaps, candlesticks, price volume. Look, a lot of times we're featuring different key support areas, price support to look for on pullbacks, that sort of thing. Anyhow, if that interests you, it's a great way to learn more about how we look at the market. And I would certainly recommend that. Also, we had a big event last Saturday talking about where I thought the market was heading later this year and into early part of next year. Obviously, the event is over, but we did record it. So if you do register for this, again, it's free, no credit card required. You can simply click on that link, type in your name, email address, and it'll actually forward you to a page where the recording is. So you can watch the recording. It is a very lengthy recording, but it's also a very detailed timestamp on the recording, so you can go in and look at exactly what it is that might interest you. All right, let's take a look at what happened yesterday. We saw the Dow Jones Industrial Average down almost 1%. So we were down 308 points on the Dow. We finished at 31,790. So we did lose 31,800. Also, we lost the 50-day moving average. And that is one thing I would take away from yesterday's action. Losing both the 20-day and the 50-day, and the S&P 500 losing 4,000 psychological support. None of that is any good in the short term. So I would certainly be cautious at this point. I get questions all the time. Does this change your opinion on the bottom? The bottom back in June was a longer term call. So no, I still believe that is the bottom until the market tells me otherwise. I saw sentiment indicators pointing to that being a bottom. The rotation in the market pointed to that being a bottom. So I'm sticking with that call. However, the uptrend that ensued is no longer an uptrend based on the breakdown from that Friday where Fed Chief Powell gave that Jackson Hole speech. That breakdown right there took out price support here, took out the 20-day moving average. We moved back down now. We've continued that selling to the point where we've lost the 50-day moving average. I don't know if or when it's going to turn. Obviously, I'm looking at signs every day trying to see. I will say historically, let me give you some numbers. And this doesn't guarantee anything. I'm not trying to say it does, but these are historical facts. The best period to be in the stock market during the calendar month is from the 31st to the 2nd. And I'll read you some numbers here in just a second. So for the 31st of the month, and this is for all months. So 31st of January, obviously there is no 31st in February. So it's the 31st of January, 31st of March, 31st of May, July, August, and so forth. The annualized return for all of those days since 1950, that's a lot of days, is 26.43%. Now, the average annual return since 1950 on the S&P is 9%. So the 31st has a historical tendency to outperform the averages by about a 3-to-1 clip. When you move to the first of the month, that annualized return jumps to 45.45%, which is 5 times the average. And the second of the month is 41.18%, which is about 4.5 times. Now, the other thing I'll point out here too is that if you look at every day since 1950, every day of the month of every year since 1950, 53.5% of the days have been higher, which means 46.5% have either been flat or lower, mostly lower. So the odds of waking up in the morning and having an up day since 1950 are just a little bit better than 50-50. It's just that the up days tend to be much, I guess, much better on average than the down days. And again, there's a slight advantage, 53.5% to 46.5%. That percentage chance of an up day jumps on the 31st to 56.48%, and on the 1st to 61.96%, and on the 2nd to 60%. Now, notice first off, I'm not saying 100%. So there are no guarantees. When the market is technically weak, as it is right now in the short term, I tend to pay more attention to what's going on in the market than I do to these historical indicators. But I just want to let you know, because one of the things I studied when I got into really analyzing this, when I got out of public accounting and I put these spreadsheets together, one of the things I really was interested in looking at was what impact money flows had coming into the market. So when payrolls, everybody puts their money into their 401k, and then you have payrolls a lot of times at the end of the month, in the middle of the month. I wanted to see what that money flow coming from firms throughout the world into the stock market, that money goes into the Vanguards and Fidelities. I wanted to know what kind of impact that had. And it was pretty clear when I started doing this that it has a massive impact. So we've got money coming in from various firms and so forth at the beginning of the month. That is indisputable. However, if you've got trillions of dollars already in the market, if the market's selling off, it's still going to overwhelm that new money that's coming in. So you have to kind of keep it all in perspective. What I like to do, though, is if I think the market is set up, or maybe it's just making a breakout toward the end of the month, it makes me feel a lot better because I know historically the 31st, 1st, and 2nd do well. Anyway, I'm just pointing this out. It's just a historical fact. I'm not trying to say the market's going up the next 3 days because of this, but there is that tendency, that historical tendency. I just want to make sure everyone is aware of. Looking at the S&P 500, though, again, we got the breakdown in price from that Friday Jackson Hole speech. Then we saw further selling the last 2 days, Monday and Tuesday of this week, and we've lost some key levels. So the bears are definitely in control right now. The bulls are on the defensive. And the question is, how far do we go down before the bulls regain control? There are some that think we're going right back down to the prior lows and even below. I don't think that's what's happening, but it's possible. What I would suggest at this point, and coming off of the bottom and what we were talking about with members, even back at the highs, that was going into option expiration week where we had a ton of in-the-money call premium, and we wanted to make sure that we were more cautious going into that week. So there was no need to be into leveraged ETFs. I mean, obviously, cash was a much better alternative than being long, period. And we saw what happened going into option expiration week the next day. And then probably the worst call I've made over the last few months was when we came back up through the 20-day, we had positive divergences on the 60-minute charts. We had some, I think semiconductors were hitting a major support area. So right at this level, at this support, I said, this is the time we're going to really rip back to the upside. That's what it looked like. And we did until 10 o'clock on Friday morning. The market reacted, and we have to react with the market. We lost some key support levels. I would be very cautious with this market right now. Again, not quite sure exactly where it goes or where it turns. I had a couple of ideas. One of them was pretty much 4,000. I mean, that's where we broke out back here. You can see in July. That's also where the 50-day moving average was coming up. So going back down and closing below 50, the 50-day and below 4,000 was not good. So unless we can quickly right the ship and get back up above those levels, and even that doesn't take us completely out of the woods, I think if we do rally, we're going to have overhead resistance at about 41.20 and close to that 20-day moving average, which is 41.24 and now dropping. Also watch this PPO, which has been above zero since the latter part of July. Looks like we're starting to roll back over. Haven't gone negative yet, but it certainly looks like we're on that path if prices continue to go lower. So if it sounds like my tone has changed, well, it has. The market's changed. As a technician, especially as a short-term trader, you can't just stay in and hope that it goes back up to those highs. You need to see some solid technical evidence. And right now, I'm not seeing that. The NASDAQ was down 134 points. If there was one positive takeaway, and I didn't see a whole lot of yesterday, but if there was one, the NASDAQ went down about the same as the S&P. Normally, during these sell-offs, I would expect, the technology-laden NASDAQ to really underperform, but technology really didn't perform that poorly yesterday, as you'll see in just a second. Mid caps down 1.4%, small caps 1.5%. Energy down 3.39%. So we had that huge move up in crude oil prices on Monday. Energy took off. You can see right here up to 85, looked like it was setting a new high. Yesterday, crude oil prices tumbled down about $5 a barrel. And as a result, energy gave back all of its gains and then some. Still got the 20-day moving average. I wouldn't be overly concerned, but I would be watching this level because crude oil prices went back down below $93 a barrel. I don't know. Actually, I can probably tell you here in 1 second. Let me see where they are right now. All right, crude oil prices. This is weird. I'm going back and CNBC still showing futures higher. So we'll take a look at the QQQ again in just a minute. Let's see here. We've got crude oil. Yeah, crude oil down another $1.35 this morning, 1.5%. So it's back to 90 a barrel. If you remember, 93 was kind of a key support area for a while. We went down into the 80s, came back up all the way up into the mid to upper 90s, and now we're dropping back down again. So it looks like crude oil might be rolling over again. Natural gas down a little bit. See what the 10-year treasury yield is doing. 10-year treasury yield up 1 basis point. So even with Mester's, that's one of the Fed officials, even with Mester's remarks about the benchmark going above 4%, no cuts for at least the next year to year and a half, 10-year treasury yield just kind of sitting rather flat. Interesting. So let's see. I wanted to go over the rest of these sectors. So there's you've got energy down 3.4% yesterday. That was by far the worst performing sector. Materials down 1.6%, utilities 1.46%, industrials 1.44%, real estate 1.43%. So as I look at this yesterday, as I mentioned, the one maybe it's a slight positive. I'm kind of stretching it a little bit here. But if I was to take a positive away from yesterday's action, the fact that the NASDAQ didn't significantly underperform would be one takeaway. And where's discretionary, where's technology, and even where's consumer staples? Because consumer spending, you start talking about, all these rate hikes coming, and potential recession and all, you would expect that these consumer stocks, when the market sells off, would not be doing well, but they're nowhere to be seen here on the leaderboard, the lagger board, I guess is what I should call it. Anyhow, some defensive groups in here, real estate and utilities. Again, I try not to read too much into one day's action. It's just something over time you want to keep in mind, which is why I like to bring it up on this screen every day. Like to kind of see what's going on with all the sectors, like to see what's going on with all the major indices. 10-year treasury yield. Let's see. Actually, I think we were getting I didn't look to see the ADP report. There it is. So the consensus estimate was 225,000. That's an estimate, but I think that's the actual. So it looks like the ADP employment report came in below expectations. I had not seen it till we started the show. That's why I wanted to look at it there. That was the big economic report out for today. And as you can see, I'll give you an update here. Not really much of a reaction right now, 1.5 basis points higher. I do think in the short term, we are trending higher on the 10-year treasury yield. So we want to keep an eye on this, because as we trend higher on this, the S&P 500 is trending lower right here. So it stands to reason. And of course, first half of the year, if you go back and you look at that 10-year treasury yield, look what the yield was doing all the way through mid-June. And you look at the S&P 500 beginning of the year through mid-June was going down while interest rates were going up. So yeah, this is definitely one thing we want to keep an eye on. And right now, the 10-year treasury yield continues to move higher. So as long as that relationship exists, I would continue to monitor it. And right now, it's trending above its 20-day moving average, which is another reason to remain cautious in the near term as a trader on the S&P 500. All right, a couple of other S&P 500 charts that I want to show you. One, this is currently going back over the last many, many years. And the reason I want to show this is the S&P 500 chart for the last 20 years. Down at the bottom, I've been asked why, I've talked about the XLY, XLP ratio being one of my sustainability ratios, and how I use that as something to just help me determine whether the S&P 500 rallies are sustainable or not. And it's simply because as I've gone back and I've studied history, I've seen the market make changes, from uptrending to downtrending after I've seen changes in the XLY to XLP ratio. And the first thing I wanted to show you here simply is this. This is the correlation coefficient that you can use over at stock charts. This is I think one of the most important tools that stock charts has, especially if you'd like to do a lot of research and you're trying to see what makes the stock market tick. I think this correlation coefficient is so cool, because you can look, if you have a theory, you can either prove or disprove that theory by looking at correlation. So if you think that energy outperforms the S&P 500 when crude oil prices go higher, you can test it. I mean, I'll come back to this, but let's just look at that. So here's crude oil prices I'm going to put up for the last 20 years. And we want to know what the correlation is to oil prices going up and how energy, XLE, does relative to the SPX over the last 20 years. And what you're going to find, here's the correlation. It's almost always positive. Sometimes it goes down. So it's not always, it's not perfect, but that's a pretty good clue. When crude oil prices are trending higher, energy tends to outperform. Doesn't mean energy goes up. It means energy outperforms the S&P 500. And when crude oil prices go down, energy underperforms. Maybe that's kind of common sense to everybody. Maybe you're shaking your head saying, well, that doesn't tell me anything. It's what I would have expected. My point here is you can use this indicator to test anything you want. So let's go back and let's look at the S&P 500 that I had here. And let's look at how it correlates with the XLY versus the XLP. And you just come down here in the indicators, put in your correlation. The correlation, I think, defaults to the SPX. Just change that. XLY colon XLP, comma, the 20 is just looking back the last 20 periods. So this is a weekly chart. So each one of these price or, points that are plotted on here are plotted based on how the S&P 500 and the ratio, the XLY versus the XLP, how they trend. Do they trend together positively, or do they trend opposite one another? When I look at this, I think it's pretty clear. This is 20 years of data. I mean, are we always, are we going hand in hand at all times? No. But is this a useful relationship, intermarket relationship, to maybe study the S&P 500? I would say yes. In fact, it's one of the strongest correlations that I can find when I look at any intermarket relationship. So I wanted to explain this because I've had folks say, well, have you gone back and have you looked at the XLY, XLP during other periods in time? Well, this is giving you 20 years right here, showing you that it is a pretty strong. And one of the things, just to kind of highlight how strong it is, what I like to do is, so take this and just shade the positive 0.50 to 1.0. That's where you're talking about really significant positive correlation. And then if I take same thing, excuse me, and I drag it down here, or I just set this up, this is when the relationship is strongly inversely correlated. Well, I only see us in 20 years, one time even touching it. And yet look at the positive up here, consistently up there. A lot of times right at 1.0, which means they are going hand in hand to the upside. So if you want to know why I follow the XLY, XLP, hopefully this is a chart that shows you why. It's not just some random thing that I pointed to back in June and said, oh, the XLY, XLP is turning up and the S&P is going down. That means that's a good thing for the market. It wasn't just because of that. It's because of the long-term history of this. These two tend to go together. When they start to diverge and go opposite one another, it doesn't happen very often. So you need to take note. That's just one piece of the puzzle, but it's an important piece. Now this is the technical side of things. If we just talk about the common sense side of things, why wouldn't you want to look at discretionary versus staples? 2/3 of our GDP is consumer spending. So of course you want to focus on consumer stocks and how they're performing relative to one another. All right. Anyway, enough time spent there. I wanted to go through and just talk about a couple of key groups, because it's been pointed out, and of course I follow these charts, but I've had a lot of folks say, how can you be bullish the market when the semiconductors are underperforming? And honestly, that's a great point. I would love for the semiconductors to be performing better. This is a negative for the market, because if you look back, when the stock market takes off, it usually is being led by this group. So if there's one thing, if there's one piece of the puzzle that points more bearishly, I would say this is one of them. Semiconductors have just not really been able to break out. Even when we moved higher in July and in the early part of August here, we didn't take out that June high. If you look at the S&P 500, that August high was well above the June high. So I don't even have to pull up a relative strength chart to tell you that semiconductors are not performing well on a relative basis. Not only that, but they've rolled back over and now clearly are trading below the 20 and the 50-day moving average, and their PPO's already gone negative. So I'm not just trying to sugarcoat everything. I realize semiconductors are not strong right now. When the market bottomed in mid-June, semiconductors didn't bottom until the early part of July. And is it the bottom? I don't know. If you're bearish and this goes to new lows, that's certainly going to be a feather in your cap. And I would say from a technical perspective, I mean, we could bounce at any point up to the 20-day. That's during any downtrend, but I'm not going to be more bullish semiconductors until we can get back through the 20-day. I mean, coming out of that, when I thought the market was turning up and I thought semiconductors might lead, that's what I told members right in here this week. That was after options had expired. We came down, we saw positive divergences. If you look across here, this was a gap support area. There was price support. Here was price support. And the 60-minute moving average, if we look at that down here at this low, was positive. So right in here is when I sent the chart out to the members and I said, semiconductors are at a low. They got a positive divergence. I'm expecting a big move here and it could lead the next rally in the market. And you saw what happened the next 2 days and really right up until the Jackson Hole speech. And that changed everything. I mean, as technicians, when you get new information, you have to change with it. This was a big breakdown, not only in semiconductors, but in the overall market. And we have yet to see the market recover from that. So yes, even if I'm bullish from my mid-June bottom call, I'm still going to be cautiously bullish and waiting for some strength at this point. I need to see the stock market get back up through the 20-day moving average. That, until we see that, I'm going to be more in a short-term bearish camp or cautiously bullish, because I do think over time we're going to go higher. The other thing that we've talked about is that if the market is going to go lower, and this is one of the things I talked about at the Saturday event, I laid out what I thought was going to happen, basically the balance of this year. And I provided a couple of different scenarios. And one of those scenarios is that we struggle in the month of September, end of August and into September, just because historically that is a time period when the market can have some problems. But the other thing I pointed out, and this is one more interesting historical fact, and we'll get ready to wrap up the show. If you look at the period from, October 27th close, October 27th close to January 18th close, that period is the most bullish period of the year. It has gone up. That period ends, January 18th. If you look at January 18th and compare it to October 27th of the year prior, it's been higher 62 of the last 71 years. Now, that's not 100%, but it's about 85%. That's a lot. That's a pretty strong probability. Now, maybe this is the year that it doesn't work. I can also tell you that it has worked 36 of the last 39 years. That's more than 90%, going back 4 decades. So what I pointed out was September, here's the bear's opportunity. This is it. Now, maybe it's one of those off years. Maybe we do go down through that October through January period. I'm just pointing out what I know from historical facts from doing the studies I've done. October 27th, January 18th. Those 2 days, you might as well just mark them on your calendar, because historically, that is the most bullish time of the year. So what are we going to do between now and October 27th? Well, we're going to all find out. But I would watch, now that we've broken down, first step, get back through the 50-day. I mean, we lost that yesterday. Get back up above 4,000. And then the next step is going to be, we had some support here around 4,100 to 4,120. Got the 20-day moving average at 4,124. We got to get back through both of those, price resistance and the 20-day EMA. So, I don't want anyone to think that just because I called the bottom in June, that I believe the stock market has to go straight up. In fact, I talked about it back then. It could happen a couple of different ways. What I did point out is that 1 year from the bottom, we've averaged 1 year from cyclical bear market bottoms, we've averaged rising 42%. That's been the average. Doesn't mean we go up every day for the next year, but that's a pretty strong signal if, in fact, the June low is the key low. Anyway, we'll see. Couple things I want to look at before we wrap up here. First thing is wanted to just check those futures. Actually, is it 9:30? It is 9:30. Don't need to check the futures. Let's just see what the market's doing. So we got S&P up about 14 points. We're right at 4,000 right now. Couldn't be much closer to that psychological level. Actually, let's look at the QQQ. This tracks the NASDAQ up 0.73%. I don't know if at 9 o'clock when I started this show, if that was a bad quote I was getting, or if, I don't know, whether futures came down, then it went right back up again. Because 0.73 is about where we were when I looked around. It was probably 8:30 or 8:40. So I don't know what the heck when I was pulling stuff up at the beginning of the show. But anyway, that's where we are right now. I wanted to just give you a couple of stocks that reported. So let's look at CrowdStrike. They reported last night. You can see the stock's up 2%, so getting a decent move to the upside. I like to look at relative strength going into earnings and just see what was, well, I mean, CrowdStrike relative to software was at about a 4-month high. So it's been one of the better performers in software, and they came through with a decent report. So not bad there. We're going to do just two you must see. This is one right here, double top. I would say 205, 206. We got to see CrowdStrike get through that level. To the downside, I'd be worried if it dropped back below maybe 185. So we're in that range for right now, and we're sitting right in the middle of that range. The other one I wanted to look at was BF/B, which is Brown-Forman. This is in the distillers and vintners area. They reported this morning, and you can see so far not a great reaction. It'll be interesting to see. This has got a very strong AD line, and you can see the last few days, the AD line's been coming down because we've been finishing near lows. Watch for a possible reversal on this one. This will be an interesting one if it goes down maybe a little bit below 72. I'm going to say into the 71s. I wouldn't be surprised to see a reversal there. If it doesn't reverse there and keeps going down, closing back below the 50-day and below this double top right here would not be good. So let's see how this day unfolds for Brown-Forman. All right, that is it. Let's get a quick update on the major indices, then we'll wrap up. So right now, Dow down 63, NASDAQ up 63. So we're seeing a little bit of a pullback from what I just gave you. Looking over here at the S&P 500, we got Facebook and Netflix, PayPal, all leading to the upside. Kind of an interesting group. And to the downside, just kind of, yeah, there's some energy names in here for sure. That's Seagate. So HPQ, another technology firm, but mostly it looks like it's energy and materials down here. That started off weak. So anyway, that's it for me today. Tomorrow I'll be back tomorrow over at Stock Charts TV. Right here, you can see it. All you have to do is click on that at 9 o'clock and you'll be able to listen into the next show. And that's it. So everybody have a great rest of your day, and let's see what the market can do if we can get back onto more solid footing or whether this downtrend continues. Have a great day, everybody. Happy trading.